Good morning and welcome to the Energy Prospectus Group webinar hosted by Rubellite Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Good morning, everybody. Thank you for joining us. I'm really excited about this webinar because Rubellite Energy is one of the companies in our small cap growth portfolio. So again, welcome to today's webinar. It is being hosted by Rubellite Energy, a small cap upstream company that is based in Calgary, Alberta. Joining me today is Sue Riddell Rose, the company's president and CEO, and Ryan Shea, the VP of Finance. They'll both be able to answer questions at the end of this. Rubellite Energy was incorporated by Perpetual Energy with a spin out of Perpetual's Clearwater assets in July of 2021. And shortly after that, they did an equity financing and the Rubellite common stock was publicly listed in September of 2021. So going from less than 500 barrels per day of oil in the fourth quarter of 2021, Rubellite's production has grown rapidly to over 12,000 BOE per day in December of 2024. Today, the company is engaged in exploration, development, and production of oil, gas, and NGLs in Western Canada. It is primarily focused on production of heavy oil from the Clearwater Formation and the Manville Stack in eastern Alberta, utilizing multilateral drilling technology. Prior to the fourth quarter of 2024, all of Rubellite's production was heavy oil. Now they have a mixture. But the company closed two significant transactions late in 2024 that have really transformed the company. On August 2nd, 2024, they closed the acquisition of Buffalo Mission Energy. And on October 31st of 2024, the company closed the recombination of Perpetual Energy into Rubellite in a stock for stock merger of Rubellite of Perpetual into Rubellite. So Perpetual is no longer publicly traded. They are just in Rubellite Energy now. So these two transactions more than doubled Rubellite's production to approximately 12,000 BOE per day in November of 2024. So today, Rubellite is pursuing a robust organic growth plan, which is why I put it into our small cap growth portfolio. And they have over 300 development drilling locations and much more exploration upside. Based on my forecast model, Rubellite should be able to generate steady production and proven reserve growth funded entirely by operating cash flow. So during the webinar, if you have questions, please type them into the chat box and we'll answer them at the end of the presentation. With that, I will now turn it over to Sue Riddell Rose for an update on Rubellite Energy. So go ahead, Sue.
Okay, thank you, Dan, and thank you for the opportunity to present to you today. So we'll do a run through of our corporate overview deck, and then Ryan and I would be happy to take some questions at the end, and we'll watch the chat box as well. So if we could go to the first slide, maybe just a little bit of history, and Dan set this up really nicely for us. We actually incorporated Rubellite in July of 2021 with the notion that there was a fantastic new play in the Western Canadian Sedimentary Basin in eastern Alberta in the Clearwater Formation that was being unlocked with this multilateral drilling technology. And at that point in time, there were not very many ways to participate in the growth of this new play and this exciting new technology in the public market. So Rubellite was a foray into that. We as Perpetual had just started getting our feet wet in terms of understanding the Clearwater assets, we had amassed about 100 net sections of land, one development property where we'd only drilled 6 wells. We were producing about 350 barrels a day at that moment in time, and decided to spin the Clearwater assets and the undeveloped land that was prospective for the Clearwater into Rubellite. So that was in September 2021. And really, we have been growing the asset base through the drill bit, growing organically from on the development side, we've been exploring, and we had some very positive exploration success that actually turned into a development property and is actually at Figure Lake and has buoyed the organic growth plan. The plan was always to have a complementary merger and acquisition strategy. We had looked at lots of things, have been very disciplined in executing, but in 2024 we had a successful foray into a new area that uses that multi-lat drilling technology, Buffalo Mission acquisition for the Manville Stack, and that has exploded our growth. And then, as Dan pointed out, it was back in November of 2024 that we actually recombined the perpetual assets with Rubellite, one for additional scale and also from to capture some synergies and enhance our financial flexibility. So I'm happy to walk you through the story and some of our assets today. Everything that you should take away, I guess, about Rubellite, it's probably contained on this slide. So in terms of investment highlights, we are, I would say our focus, at least our business strategy focus, is on that pure play heavy oil multi-lat asset base. We now have about 582 net sections of lands that are prospective for the Clearwater and the Manville Stack and heavy oil exploration. The major producing properties that we have are at Figure Lake in the Clearwater and Frog Lake in the Manville Stack. We're also very much an active explorer, and we've accumulated and captured lands in multiple exploration plays that we are slowly investing capital on a risk managed way to unlock. We've got good line of sight, I think, to expand that exploratory inventory. And the other exciting piece that you'll hear about today is although we have been developing our properties on primary with this multi-lat drilling technology, we also know that this the opportunities with only 5% of the oil in place actually being targeted through primary recovery, the exciting opportunity using solvent low-grade heat technology to move into a EOR type of arrangement has the potential to add a lot of value. So we have been active drillers. We have either run a 1 or 1.5 rig program since our inception, pretty much steadily. The Clearwater is really defined by these highly profitable full cycle IRRs per drilling activity, per well drilled. Typically, our payouts for the last 3 years have been under 1 year, and at current strip pricing, that's extending a little bit, but we're working on ways to bring the capital down and get through this period of lower prices with a view to prices actually getting stronger again in the next 9 to 12 months. We would have we'll walk through this, but have what we would say are about 8 to 13 years of development drilling inventory, depending on how the pace that we actually develop that at with that 1 or 1.5 rig program, and then also lots of locations to fuel that development drilling with the exploration activity. We set out with a goal to actually get to free funds flow within 3 years of our development, and we actually accomplished that in 2024. So our growth plan now is fully funded and generating free funds flow. One of the trademarks, I think, of this play is that the cash costs on this heavy oil production is quite low, especially on the operating cost side. It's quite a simple operation where we are actually developing from pads and then processing the oil just through heat to break it down and then separate water and truck it away. So we've got very attractive operating netbacks in that amongst the top for any play, depending on the price, the revenue side of the equation. As I mentioned, we're generating sustainable free funds flow now, and we have a very active hedging program that actually sets us up nicely for this period of weakness, I think, through the remainder of 2024. On the capitalization side, we have raised equity a number of times, but the most recent acquisitions at least the Buffalo Mission acquisition, we actually did through an expanded credit facility. So our bank line today sits at 140 million. We're drawn at year end 2024 about 106 million, probably slightly down from that by the time we release our quarter. And we also have a $20 million term loan that expires in about 4.5 years from now. Net debt to our annualized funds flow from our Q4 report was about 1.1 times. And again, that is trending downwards as Q1's funds flow should be slightly stronger than Q4. And we'll talk about the recombination, but we added about 4,000 BOEs a day of liquids-rich natural gas production in November through the recombination with Perpetual. And we think about this as something that has diversified our revenue stream, given us quite a lot of financial flexibility and some optionality in what we view to be a strengthening gas market that we're really on the cusp of in participating in Western Canada, since we have LNG Canada starting up in June of this year. Maybe the last point of note is management is very much aligned with the shareholder for our company. Insiders own about 44% of the shares outstanding. We have been participants in the second lien term loan that's outstanding as well. And from an operational excellence and ESG point of view, this is just a play that lends itself nicely to that, because we're drilling we're not using fresh water. We're actually using OBM in our drilling systems. We aren't fracture stimulating. We're on multi-well pads, so very limited surface footprint. In fact, I'll tell you a little bit about a gas conservation project that we just completed and brought on stream in January of this year, which is reducing emissions, but also creating some value through the gas sales. So that's the snapshot of everything you need to know to take away, but we'll do a bit of a deeper dive on some of these points. So as Dan mentioned, we did do 2 very strategic transactions in 2024. We had largely grown through the drill bit prior to that. So by Q2 of last year, we were producing up to about 4,500 BOEs a day, almost exclusively heavy oil. We had identified the application of the multi-lat drilling technology to new formations in the Cold Lake oil sands area, and targeting what we call the Manville Stack, multiple zones. And Buffalo Mission had compiled a very concentrated position in partnership with the Frog Lake First Nation, and amassed 2,500 net barrels a day of production. So we made that acquisition and carried on with their activity, and we'll share a little bit about what excites us about that asset. And then, as I mentioned, at the end of the year, we recombined with Perpetual for the extra 4,000 BOEs a day, which is largely gas with about 18 barrels per million. It's about 20 to 25 million a day of gas with about 18 barrels per million of NGLs. So that set Perpetual up with about 11,000 BOEs a day of production at the end of those recombination and the acquisition. And then, of course, we had continued good organic drilling program that's actually taken us north of that 12,200 range today. One of the things that excited us about the Buffalo Mission transaction was the development inventory, but beyond that, some of the exploration ideas that are amassed within that Manville Stack as well. So really the highlights of the asset base were large-scale exposure to heavy oil in both that Clearwater and Manville Stack multi-lat play. Lots of heavy oil development drilling inventory to support our growth going forward for 8 to 13 years, depending on the pace of investment and drilling and scale of growth. The exploration prospects were slowly de-risking those, learning and investing in a risk-managed way to actually unlock what will open up that resource. And then I also mentioned we have an extensive exposure to enhanced oil recovery on all of these assets with that very large oil in place. And then, of course, the Deep Basin asset brought us the commodity diversification and financial optionality. So Ryan, if you wouldn't mind, please advancing to the next slide. Yeah, so just a snapshot of where we sit right now. Our enterprise value is about just under 330 million of total enterprise value. Market cap only sitting at about 175 million, and debt at Q4 was 154. Mentioned the 44% insider ownership. I think we are of the view that there's opportunity as we have unlocked, I think, some significant value, and as our shareholder base starts to understand that value, to convert that or to grow that enterprise value, hopefully on the back of the market capitalization. Our production growth has been pretty much delivered what we said we were going to do over the 3.5 years that we've been in existence. We've had about a 70% average annual heavy oil production growth rate, higher than that when you actually incorporate what we did with the perpetual recombination back in November of last year. And we're forecasting continued growth for the heavy oil production base in 2025 as well. Our guidance for that we put out in March for the full year is 12.2 to 12.4 BOEs a day total production for 2025. The chart on the far right-hand side is really what we have been focused on growing, and that's adjusted funds flow. And you can see the steady growth quarter after quarter on not just a funds flow basis, but also on a adjusted funds flow per share basis. Up and to the right is what we always say is the direction we want to go here. But that 104% average annual adjusted funds flow growth is something that we're very pleased with. Moving to the next slide, just some performance indicators on our asset base, particularly on the heavy oil side. So as I mentioned, our focus is actually on this heavy oil business strategy, business plan, and this part of our strategy. Our Q1 guidance for heavy oil sales is 8,000 to 8,200 barrels a day. We should be at the high end of that guidance and exceeding it probably slightly. In terms of operational metrics that have delivered this, we have drilled since our inception over 1,300 lateral legs. We're now averaging, we have a well design that averages about 15,000 meters per well of open hole. We just completed our longest or our highest open hole meterage in a single well just a few days ago, actually, at almost 20,000 meters. And when you add all of that up, we have actually drilled over close to 1.6 million meters of horizontal open hole in the Clearwater and the Mannville Stack. So we feel that we're getting good at this. We've been driving our capital efficiencies down over time, and we forecast that to continue to decrease as we capitalize on some of the ideas and learnings through the drilling program. And that was actually at a point in time in 2023, 2024, where we were fighting a fairly heavy inflationary tape. So we expect that to, well, it's certainly stabilized, and we expect it may even reverse itself with with the lower commodity price forecast in the near future. In terms of once a year, we get an opportunity to sort of do a bookkeeping of what we've accomplished in terms of reserves. And this is just a summary of our 2024 year-end reserve report that was prepared by McDaniel and Associates. You can see that our reserve life actually works out to be about 23 years, calculated recycle ratio of 2.8 times on the heavy oil assets. In terms of value, the total proved and probable booked reserves of 722 million. Of that, proved and probable developed producing, so where no additional capital is required, almost 400 million. The growth year over year on both absolute basis and debt adjusted share basis has been significant, and you can see again steady growth year over year in all categories, PDP, PPDP, and total proved, as well as total proved and probable. How that all translates into value, we characterize as our reserve-based net asset value. So we like to look at, okay, where are all of our obligations and liabilities, including all our asset retirement obligations, et cetera, and start from the bottom and then build up beyond that through the different reserve categories to actual what we would call a net asset value. So with starting at the obligations that we have and building up from there, you can see that our proved developed producing, including a fair market value of the undeveloped land that was also recorded at year end based on a Seton Jordan report, that would actually get you just on PDP $1.97 a share. If you look at again just the build up on the P plus PDP, that's $2.40 a share without the undeveloped land, $2.92 a share with the undeveloped land. So lots of value that's actually embedded in our share price, and at our total proved and probable, which we think is a good reflection of the asset base, including the fair market value of the undeveloped land, that would translate to $6.47 a share. And again, good growth year over year, $2 a share at our inception being what we actually did the original transaction price or sale to or purchase from Perpetual at of the Clearwater assets. So a snapshot of the assets, all in Alberta and all in basically northeastern Alberta. The Clearwater is kind of through the main part of the map sheet where we have our Ucalta, Figure Lake properties. We've got a property in Martin Hills, some exploratory acreage in the Dawson area and Calling Lake regions, as well as some other items that aren't actually exploration properties that aren't annotated on the map here. The Manville Stack is actually to the east of here in the Cold Lake oil sands area. You can see Frog Lake virtually due east of our Ucalta and Figure Lake properties, and then East Edson due west of and slightly south in the Deep Basin of Alberta. So the largest property we have by production and by land base and by well count is our Greater Figure Lake area, accounting for close to 2/3 of the production on the heavy oil side. Frog Lake is actually our second largest property, and then a few other properties that we've carried, Ucalta and Martin Hills, Martin Hills being fully developed and now on water flood. So that works up to our 12,000 BOEs a day, and just maybe highlight some of the bitumen assets that we also have. The portfolio of assets that we've put together on the bitumen side are their oil sands leases that are almost flow from they're relatively light bitumen, so they're really heavy oil. And the technologies that we're actually working on for EOR in our Greater Figure Lake area and at Frog Lake, we think will have some application to some of these bitumen properties that we've been carrying, and those joined us back from the Perpetual recombination. So in terms of inventory, we mentioned that we have 316 booked and unbooked development drilling locations that will fuel our growth. You can see that our properties in Frog Lake have, in the south part of Frog Lake, in the main producing zone, the Waseca, those would be our best economics at about 150% rate of return. This is on the McDaniel price deck at year end. And then really the Figure Lake, although McDaniel has differentiated them as Tier 1 and Edwand and Tier 2, we actually look at all of that inventory as being pretty much at that Tier 1 valuation, but we presented it as shown in the reserve report here. And then the Frog Lake Waseca North is slightly lower quality, and that also is based on the historical drilling technology that's been used at Frog Lake. The zone is a little bit thinner there. They were using, Buffalo Mission was using a water-based mud system. We've actually now switched that over to an oil-based mud system, and again with the notion that we think we can improve the economics really so that they're all kind of in that 100% rate of return, sub 1 year payout kind of range. The next slide is a deeper dive on our Figure Lake property. And just to orient you a little bit on the map, the green outlines are really what we have identified as the mapping parameters for a type curve well. And if we are within that green area, and assuming the structure is where we need it to be, we think that those green sticks will actually deliver on average type curve performance through this whole area. So our internal type curve being the same really through this whole region. We did a few things in 2024 that were quite interesting, and I'll tell you a little bit more about those. We were worked on refining our optimal well design, and we did in the circular area in the southwest part of the main pool, or southwest part of the main pool. We did a downspace pilot to help us inform what the appropriate interlake spacing and meterage of open hole would be to generate the optimal value. So we have actually, that was very successful. We have adopted 33-meter interlake spacing as our base well design, 15,000 meters of open hole. And I'll show you how that translates into the economics that McDaniel carries. The IP30s that we recorded for all the wells that we drilled last year at that 33-meter spacing were kind of north of 220 barrels a day on an IP30 basis, and almost 190 barrels a day on an IP60 basis. And I highlight that because the type curve from McDaniel on IP30 is about 178 barrels a day. So we did actually have better performance than what our type curve is, and we're earning our way to, I think, recognition of stronger performance as we get sort of deeper into the production history of some of these wells. The second thing that we did in 2024 was actually a delineation program. The main pool that is highly connected, we felt very confident in the inventory there. Lots of booked reserves were showing up in that region. As you move down south into what we call Edwand, the pools break up a little bit. There's a little bit more structural complexity. And some of the original wells drilled in that pool were by a company that we acquired some of these assets from, and they had not really generated type curve performance. So our goal was to actually show that with our well design using OBM mud, staying in zone, using some of our technology to monitor performance while drilling, that we could actually generate type curve wells. And to the point of McDaniel actually booking slightly reduced tier 2 curve, our goal was to actually show that we could generate that tier 1 type curve. So that was also very successful, and we'll share some results on that in just a minute here. The last thing we did last year was construct a 5 million a day gas plant and gas gathering system. We have the benefit of this being an active area for shallow gas that actually had been basically shut in. So we were able to pick up significant number of pipelines and reactivate a meter station and basically reconstruct a gas plant in that area for relatively low cost. So that came on in January of 2025. We've been slowly ramping up our production. We're up to about 4 million a day now. And as we continue to grow in here with additional oil production, we'll need additional takeaway capacity as well. So be continuing to actually tie in wells and expand the gas production through here. So So we, in this Figure Lake area, leave if you wouldn't mind going back just 1 second, Ryan, we have what we would call 243 net locations. So you can see about 96 of those are actually booked in the reserve report. The remaining are what we would call prospect inventory locations, and that's where we get that at a single rig drilling program of 18 wells per year, about 13 years of development inventory. And we could go faster than that as well. A bit of a deeper dive on the delineation program that we did last year. The 6 wells that we drilled are annotated here. They are highlighted in blue. You can see that they're a little bit more spread out on pads, some of which were actually offsetting black wells that were there from the previous operators' performance that had not met type curve. And every single one of those new drills actually exceeded the type curve for our 50-meter drill, and that is actually the well design that we used to drill these. And we averaged about 195 barrel a day IP30 with not a lot of decline in the IP60. So we're very pleased with the results there, and as a result have basically everything in the Edmond area. We've moved into a high confidence drilling inventory kind of category internally. The next slide actually depicts the downspace development plan and some of the economic parameters. So as I mentioned, we have now moved our well design from this 50-meter interleg spacing, 10,000 meters of open hole to 33-meter for this very same area of drainage, 33-meter interleg spacing, which gets us 12 open hole lateral legs and about 15,000 meters of open hole. And what we were evaluating is what is the contribution in IP from that new hole that's open, and then secondly, what are we seeing in terms of ultimate recovery? So this is still relatively early days, and it was definitely early days when we went through the reserve report capture. But as I mentioned, our wells actually, the average of our wells in that pilot would have been an IP30 north of 220. The McDaniel type curve is recorded 177 barrels a day IP30. And we did get a little bit of recognition for increased recovery from this new well design and taking the recovery factor up from 5 to 5.4%. So all of this, really, this is about creating value. It's increased our IRR by about 16% to a little over 100%. Then it's increased the net present value per location, and also, of course, improves the capital efficiency and the payouts with those higher production months shifted up front. So we've reworked our development plan in Figure Lake to employ this 12-leg 15,000 meter development plan. And so with that, a 1-rig program would deliver about 18 drills per year. So to go to the next area, Frog Lake, our second largest area. Again, we acquired this asset through the combination with Buffalo Mission that we completed in August of last year. One very important element for us in getting involved in this asset was actually the partnership with the Frog Lake First Nation. The land mass is completely within Frog Lake, and it was very important for us to be aligned with the interests of Frog Lake to feel confident that we were going to be able to exploit this in an efficient way. So we are in partnership through joint economic development agreements with the Frog Lake First Nation Energy Resource Corp. They are called FLRC. They can actually make an election to participate in every well as we drill them. They're either 50% non-operated partner, or they will receive a gross overriding royalty of either 5 on the first 2 JEDs and 6.5% on the third JED. They typically actually will participate in everything. The economics for a type curve well would strongly support that they participate in everything. The nation does not actually fund FLRC with external funds, so to the extent that they have not enough capital to participate because of other things that they're doing, or dips in their cash flow, timing, etc. They do actually stay in an override position on some of the wells, and we did see that this year with 4 drills. They're actually they had completed some acquisition work that they as a company were focused on, and were not able to participate in 4 of the wells that we've been drilling so far. So I think that's to Rubellite's benefit in economically anyway in that case. So production when we acquired the asset and really through December was in that 25 or 2250 to 2500 barrel a day range, fluctuating as wells come on and off, averaging about 2230 in December. We are actually seeing some good strides now in growing that production as we've been adopting a new drilling design particularly. So when we first took over operations on the Waseca formation, we basically applied the same drilling techniques that Buffalo Mission had been using, which was using a KCl water-based mud system, using the same drilling parameters that they were using. And we have, from our experience at Figure Lake, decided to go to an oil-based mud system that actually is we think we're starting to see real positive improvements on. The other thing that excited us about this area was all of the potential in some of the other zones within the Manville stack. The technical issue with those other zones has been one of understanding how to drill zones that are not as well consolidated. So the Waseca is well consolidated, works very well in the multilateral drilling with the multilateral drilling technology. The General Petroleum, the Sparky, some of these other zones in the Lloyd are very porous and permeable. And the challenge is actually how to keep those all that open hole actually contributing to production. And so we've got some ideas on the exploration on the new well design, what we would call exploratory work this year in unlocking what we recognize as about 110 net locations across this land base in other zones within the Manville. So 2025 activity is planned right now is this 1 rig program using the OBM mud system. So we have budgeted 24 wells, 14 net to us. It's a little bit shallower here and a little faster drilling. And then one of those wells will be a GP, General Petroleum exploration test in the back half of this year. The type curves are here for your information. As they have been recorded in the McDaniel report, they would be slightly, the Waseca South would be slightly better than what we call the Waseca North. That's just based on the thickness of the reservoir in that area and the fact that the oil is slightly heavier in the north part of this reservoir. So we have switched to the oil-based mud system, and that's being driven by improving our hole cleaning and stability, reducing our water handling and disposal costs. There's a lot of water that you need to manage in the early part of the production when you're dealing with KCl water. So all of that with the goal of accelerating our time to our initial and peak production, which will improve our rates of return, et cetera. We also think the OBM gives us a nice solvent effect to sort of start the oil production and flow from the reservoir. The next slide actually just highlights that with some 2 example wells. This well on the left-hand side, a typical well design with that KCl mud system, and you can see for the early part of the production, all that water, which actually needs to be trucked and disposed of in a disposal well, which adds about $70,000, we think, to the original or to the actual handling costs, versus the oil-based mud system where we actually produce load oil. Initially, we recover for reuse about 70% of that. The goal is to actually reuse even more, but we've been averaging about 70%. The rest of that oil that isn't able to be reused is actually sent to sales. So there's a value created in an oil-based mud drilling credit. And then you can see that the production comes on significantly higher, partly related to that solvent effect. And then you start to stabilize and see what production looks like from there. So this is, I think we're 5 or 6 wells in now to using this OBM design, and our plan is to continue that as we proceed through the year. So a little bit about exploration. This is the pipeline for our development projects. We basically are focused on capturing lands in those early stages of ideas, amassing a position that's worth actually investing capital to de-risk. Then we move into the appraisal phase. You can see we have a number of prospect areas that are in that appraisal phase right now. And certainly where you have the size of the prize worthy of the risk is where we try to focus. Each of these are not unique. Some of the things that we're working on this year are actually understanding the well design that'll be applicable to the less consolidated formations. And I think if we unlock that with the General Petroleum, we probably unlock virtually everything in the front end of that appraisal phase with our Calling Lake McMurray prospect, our Sparky at Frog Lake, and also the GP. And then the goal is to continue to figure out how to get more of that oil in place out. And we're working on these EOR technologies that I've talked about until the assets mature and you're just generating free cash flow, maximizing value. The next slide, just a quick touch in on East Edson. We actually were the discoverer of this asset, I would call it, back in the 2010 to 2012 timeframe. In 2020, we actually sold a 50% working interest to Tourmaline. They became the operator, and we've benefited from them using their larger scale operations to actually bring down our capital costs in this region. So they operate. We're very pleased with what they're doing, and they seem to be very aligned in terms of pace of development with us as well. When gas prices are low, they've been slowing things down and optimizing the plant that way. They're certainly prepared to scale up when commodity prices actually improve. So for 2025, we're actually only budgeting 4 gross 2 net wells here. That should sustain our current production at that 20,000 or 20 million a day of gas and about 400 barrels a day of NGLs. There's a number of secondary zones in the it's the Wilrich that we're primarily developing in East Edson now. There's a number of secondary zones that we think will also unlock over time, either with technology or because some of them are lower pressure. We have a very large oil prospect, I think, in the second white specs that could be unlocked with technology, and then also just higher gas prices altogether. The next slide just highlights the economics of a single drill or basically a pad drill, 2 wells on a pad, 2 to 4 wells on a pad typically. So the net economics at strip pricing, about a 33% rate of return, but you can see when we're moving into that $3 and $4 per GJ range, we're getting to see rates of return that are actually and payouts that are actually competitive with our heavy oil assets. So in a higher gas price environment, we definitely can go faster, and we've just, for example, highlighted a 3 net well per year development plan, which can definitely be within the facilities infrastructure that's there right now, which is about 6,500 BOEs a day. Would anything up to 6,500 BOEs a day is basically a half cycle investment decision because all of the facilities are already in place. So just to wrap up on our capital spending plans, we've got 95 million base budget, largely focused at the 2 main properties at Figure Lake and Frog Lake, and largely focused on development drilling, but we are also highlighting exploration spending of about 5 wells or 4.5 net. Ryan, did you want to go through the guidance slide that follows?
Yeah, sure. So we put out Q1 guidance. Our Q1 results are due to be released on May the 7th after the market. We put out our Q1 guidance as well as full year 2025 guidance. The production numbers are anchored on the low end of the capital spending forecast or capital spending guidance, which is the pie charts that Sue just talked about in the previous slide. The higher end of the capital spending guidance would be to bring in an additional rig at some point through the second half of 2025 to drill an additional 6 or so wells. Just given where the forward market is for oil prices today, it would be unlikely we would go to the higher end of the capital spending forecast. So we would just end up paying down debt. We've provided some guidance on our royalties, op cost, transportation, and G&A. And I mentioned our results are due to be released on May 1st, and our fourth quarter of 2024 was the 8th consecutive quarter of achieving our street expectations, and we expect Q1 of 2025 to be the 9th consecutive quarter of making our numbers.
Great. Thanks, Ryan. I think from there, we've got some information on our hedge portfolio, our balance sheet. Suffice to say on the hedges, we are extensively hedged on oil through Q2 and Q3 of this year, and expect to see pretty much the same operating revenue that we've experienced in Q4 and Q1 here, kind of carry on throughout because of that extensive hedging. On the gas side, we did actually have a very significant amount of hedging on in 2025. We've actually crystallized most of that with the view now to wanting to be exposed to what we believe will be a strengthening gas price. And we're starting to see that already take shape. The story of the winter really was about the North American gas prices. Henry Hub was actually, we were seeing some nice anticipation of in the forward market of improving gas prices. That wasn't actually translating into AECO. And as a consequence, we were seeing basis differentials get very, very wide. Now we've actually seen some of that forward curve North America-wise at Henry Hub come off a little bit, but the basis differential is actually tightened. And so our AECO prices are actually getting more and more attractive. And that's, I think, on the back of LNG Canada being here right now. And we also had a very cold winter through in Western Canada that actually eroded some of that excess gas that we had in storage. So I think it's an exciting time to be exposed to the gas market as well.
Mm-hmm.
So with that, I think we could maybe just open things up for questions. A couple more slides on our ESG footprint, and there's a lot of information that on our website that actually has explanation of some of the slides here. But happy to get into some questions if we could.
Okay, Sue, I thought that was great presentation. Definitely cleared some stuff up for me, help me. Before I get into the questions, go back to slide 7, Ryan. I want to look at that, talk about my valuation on the company that I really took a hard look at yesterday. Anyway, so in my previous life, Sue, I worked 18 years for Hess and actually was working there when I was the CFO over North American division. And somebody just walked into our office and John Hess didn't like working in Canada or something. So he just took the offer and sold it, but it was kind of weird. But anyway, so the way I value companies is really based on what I believe is a reasonable price for the future operating cash flow per share. So when you're able to grow production and fund it all with operating cash flow, that's a big plus for me. And then you guys have a lot of running room, high quality, low risk running room, wells that pay out in a year and a half. And like you said, there's additional zones you haven't even touched yet, so you got a lot of upside there. This would be, if I was at Hess, these are the kind of packages we were really looking for that we, believe were undervalued. And then my valuation is just based on 5 times what I believe is your annualized cash flow per share for 24, 25, and 26. So, and I came up with, and I did, just for some of your listeners, I've been thinking about lowering my oil price deck, and I just lowered it like $5 per barrel for what I was previously using, and it only took my valuation for Rubellite down 25 cents. So anyway, a lot of value upside to here because I think the stock is trading at about $1.70 or something. Anyway, but still, yeah, it's a deep discount. There's absolutely no reason for this stock trading at like below, $2. It's just crazy. And I can say, we watch Hemisphere Watch and play a lot of the Canadian juniors. And I think a lot of that has to do with all the political confusion with the tariffs and, what's going to happen with the, global economy or whatever. But I think some of this is really going to clear up in the next 90 days or so. And hopefully oil prices will firm up and get there. And I do think natural gas is a totally different market that in North America is significantly improving with the increase in LNG exports for both the US and Canada, and also the demand for electricity in the US, which can only be satisfied with building more and more natural gas-fired power plants. So anyway, this is why I added the company to our small cap growth portfolio, and I think it's got a lot of upside for us. So to get into some questions, the midpoint of your Q1 24 production guidance was 12,100 BOE per day. Can you tell us what is the production mix between heavy oil, natural gas, and NGLs?
Yeah. The looks like from our actuals, we're going to be about 67 to 68% heavy oil, about 3% NGLs, and the remainder would be natural gas. That's natural gas at Edson, and then we started producing natural gas at Figure Lake with the tie-in through the gas conservation project. So that actually those are new BOEs a day as well.
Okay. And I know what is your outlook? What are people saying up there about the natural gas price? Like, what is the natural gas price now, and what do you think it's going to be by the end of the year?
Yeah, so the natural gas price for the last year and a bit has been running somewhere between $1.50 an MCF to $2 an MCF. We are now starting to exceed that, and it's really we're on the cusp of natural gas prices, I think, unlocking here in Alberta. It's partly being driven by so for 4 years we've actually been working at getting gas to the West Coast. LNG Canada is actually scheduled to start up in June of this year. That's going to actually add 2 BCF a day eventually. The initial ramp up is 1 BCF a day going to 2 BCF a day within a year of new incremental demand. And so what is the supply response for that? Well, those project owners we think are already producing some of that gas into the general AECO market and Western Canada market. So those volumes should actually shift with the startup, and then we'll see what the backfill looks like. So it's always a little bit messy to see how much is excess production. We don't think there's a lot that is shut in, but there'll be some that's just kind of waiting for that to come on. The storage levels coming into the winter actually were very, very high in Western Canada, partly because of this ramp up, but we were able to actually draw a lot of gas out of storage through the winter with just some very cold temperatures. That took us to pretty much normal storage levels. And so as we start to see LNG Canada come on, we'll start to understand how storage fills. And our forecast is for storage not to fill very much. And so we should actually see next winter and then moving into 2026 as significantly stronger pricing. And I mentioned this as we were chatting, it's those basis differentials that have been just crazy. So a traditional basis differential would be kind of the cost of pipe actually is about 70 to 80 cents per MCF. So that would be typically what we see from Henry Hub to ACO. Those have been running as high as $3 last winter. They have normalized now down to about $1.80, and we think that that's still going to come down. So there's the basis differential tightening that we think will happen because of LNG Canada. But then, as you've already alluded to, there's a really tremendous pull of supply in the US that, from data centers, from that huge build out of LNG projects that's happening on the Gulf Coast. And so, we think that Henry Hub is going to get stronger as well. So ACO will come along with that and, see a significant improvement. So $4 we think would be conservative in terms of our view. And usually what we see is when gas prices finally do recover, we get some very significant spikiness to gas prices, and so we anticipate something like that in 2026 sometime.
Yeah, I just did for some of the listeners. I just did a report on Peyto yesterday, and they have a real nice slide in there that shows all of the new LNG export facilities coming online, both in America and in Canada. So you can say, I think there's four. I think there's four of them eventually within the next few years in Canada that are going to be coming online. So, that's done tremendous for our gas market down here. Another presentation, if you look at Antero Resources, they update this about once every quarter, but based on their estimates, they believe the U.S. gas market by fourth quarter of 2026, fourth quarter of 2026 will be supply will be 6 BCF per day below demand by the fourth quarter of next year. And I think they're pretty conservative. and if this is because, Trump's, the one thing good he's doing for the industry is he's fast tracking all these LNG export facilities, because, that's a good way for us to balance our trade, help balance our trade imbalance. So anyway, so one really question I had on this topic is, if natural gas prices lift up to $2.50 per MCF, is that high enough to justify the ramp up production? Because I know on the assets you acquired from Perpetual, you've got some assets there, but that you believe you could quickly ramp up gas production if you wanted to.
Yeah. I mean, we'll be at the mercy of Tourmaline's spending, but
Okay.
I would anticipate that if they're seeing a $3.50 or $4 strip, that they will lean in and ramp that up. The asset has a very high fixed operating cost, it's actually a low cost, but a high percentage of the operating costs are actually fixed. And so getting to facility throughput is a really efficient way to produce things. So they have their eye on that as well.
Okay. Let's see. Oh, this is for Ryan. Ryan, tell us about the tax pools that you have. How long will they be able to cover Rubellite's current income taxes, do you believe?
Yeah, so our tax horizon is in excess of 5 years. So we, based on the current forward strip, which is, prices have come off quite a bit, we'd be taxable in like 2030. And obviously, as oil prices improve, that would shrink that tax horizon. But right now, it's 5+ years.
Yeah, because that's a big plus for the company's cash flow, operating cash flow, is that they don't have current input taxes for the next 5 years. So anyway, I think you answered this one. Within your development drilling locations, which you believe have the best, you had that one slide, I think it might be the next slide on this, had the best economics. And, any of these wells that have 100% rate of return, that's pretty much equates to like a 1-year payout, which is incredible. I tell you, when I was at Hess, if we drill wells, if we thought they'd pay out in 3 years, we thought they were great wells. And then on the offshore, it was drill the well, wait 7 or 8 years before you get a platform out there. That's how long this stuff took. Well, anyway, okay, let me get into some of the questions that was posted. Dale Brown is one of our members here in Houston. He's a very sharp guy, engineer. Anyway, he says, what is the probable developed slide? He thinks it's 6 Are these essentially behind pipe? I think this is one that shows you, yeah. Are these essentially behind pipe PDNP proved, developed, not producing that have less than 90% recoverable certainty?
Yeah, those probable developed are actually not, they are producing, and they are just, the reserve evaluator will say 50%, you know, when you're to call it proved, you need to have 90% view to those numbers. To call it probable, you need to be 50%. And so a portion of the producing reserves actually get this probable category. So
Yeah,
So
which is
that-
very conservative. Yeah.
Yeah.
And McDaniels, you know, they're a first class reservoir engineering firm. And, you know, we use Netherlands Sewell down here for a lot of the companies. And they're always very conservative. And, you know, like your new completion method with the 33 meters between the laterals, they haven't really given you credit for that. That'll be in this year's, like the 2025 year-end reserve report, correct?
correct.
Yeah.
Yeah.
So down that green wedge would be the difference between the P90 decline curve and the P50 decline curve.
Okay. Okay. Yeah, I mean, people just and for some of you people that aren't familiar, they do use, you know, in the U.S. There you only use proved reserves, and which is very conservative because I think the probable reserves in most of these shale plays are pretty much proved reserves, and then only the ones you're going to develop in the next 5 years, and then which I think is really a dumb thing. They look backwards for oil and gas prices. They look in the previous 12 months. Well, up in Canada, they look forward, and you might comment on this. I think it's based on the three largest engineering firms.
That's
Come up
correct.
with an
It's a
estimate of
3
future
consultant
price.
average. Yeah.
Yeah, so they're maybe a little bit higher than where we are now, but I think probable once some of this political noise at least settles down. Okay, oh, are you able to keep drilling? You're running 2 rigs right now, and they're able to keep running through spring breakup?
Yeah, we have 1 rig at Figure Lake, 1 rig at Frog Lake, and they are both on pads that they can run through spring breakup. Yeah.
Okay, and then you're able to complete the wells too during the time, or you got to wait till later?
No, that's one of the beauties of this play is that the completion is basically like a 1-day operation, and
Oh, okay.
we do things right with the drilling rig. So actually, when we're on a pad, we might have 8 wells on a pad, and we'll have the first well producing within a couple of days of it being rig released. So drilling the second well, producing the first well within a day. Yeah.
Or so you have to run tubing down to the bottom of the vertical, and then all the holes are open hole, right?
Correct.
Okay, but you do run tubing.
And we run a pump down.
Pump down.
Yeah.
Okay.
Yeah.
Okay, let's see. I think Dale had addition. Oh, what is the typical individual lateral length? And he asked, are they left open holes, which they are? Okay.
Yeah. So what we typically do is run our laterals. It's more about how you fill the reservoir. So this 12 open hole laterals on a typical well, they would be, you know, around 11 or 1200 meters each. And that would, I think that math adds up to about the 15,000. But sometimes we actually have areas where we know we're only going to be in a region once with a new well. And so we'll run these little spurs off. So some of those could be quite short, but they're just filling in reservoir space. So the goal is to leave no reservoir space untouched, basically.
Okay, from an operations side, what is TVD of formations?
The TVD of the formation, so vertical depth in Figure Lake is actually about 600 meters. It varies across the field.
TVD is total vertical depth.
Yeah, total vertical depth. And then at Frog Lake, and this is why the wells are slightly cheaper, is a little bit shallower than that. So more like 450, 500 meters.
And he asked, is this rotary drilling or coil tubing?
Rotary drilling. The hole size in the reservoir is about 159 millimeter hole. It's one of the opportunities that we have. Some of the other operators are actually going to larger hole with the notion of that just creates kind of improves the skin, gives you more reservoir exposure when you have a slightly larger hole. And so Buffalo Mission had actually experimented with that. We'd gone back to just our 159 millimeter hole, well designed, but we are thinking about going to a bigger hole sizes as a bit of a pilot this year as well.
Okay, what's your current casing size for the vertical?
Casing size, I think we're
5.5.
7-inch casing. Yeah.
Oh, 7-inch. Okay. And then I think you talked about hole size in the reservoir. So the laterals. What's the hole size of the laterals? Maybe just
that would be that 159 millimeter hole.
Okay. Somebody says, good morning. I may have missed this as I had some issue internet, but does RBY provide an adjusted funds flow guidance for 2025? Was that on your guidance slide?
Yeah, we don't have guidance. Oh, go ahead, Ryan. Yeah.
Yeah, we put out all the assumptions that people can come up with a cash flow number, the adjusted funds flow number based on what oil price you want to use. But so we don't put out official funds flow guidance. We do have 4 broker dealers that cover us that publish cash flow estimates or funds flow estimates, and they would be around 130 to 135 million for 2025, which is around $1.40 to $1.45 a share.
Yeah. Okay. What oil and gas prices are used in your base case scenario?
We run all of our every month. We look at our budgets and we use strip pricing for the purposes of our planning. Yeah.
Okay, which I think on the oil side especially is very conservative.
Yeah, with our hedges layered in as well, though. So
right.
Yeah, and we're not that sensitive in 2025 because of those hedges.
And that is a big deal on this company. The hedges it really lowers the risk on the oil side, especially. Okay, for EPG members, I update every quarter all of the forecast valuation models for all the companies in our 3 model portfolios. So they're updated on the EPG website. I just did this one yesterday. And on it, I try to take into what your realized oil price is going to be. So I put all your hedges into the formula, and then I use what I believe is a differential, which I think is it $18 or $19 or something for the heavy oil?
So our heavy oil is priced off of WCS, which is the benchmark price in US dollars.
Yeah.
And so relative to WTI, WCS is around $13 US off of WTI. Convert that to Canadian, and we typically get around $4 to $5 Canadian less than the WCS Canadian price.
Yeah. So your actual realized oil price for the fourth quarter was $82.73. That includes the cash settlements on your hedges and differentials. And my guesstimate, based on my little formula, comes up to 82.84. So just 11 cents higher in the first quarter than in the fourth quarter. So we'll see. But these are constantly being adjusted. But I've got it going down to like 75 for the second quarter, 75 a little bit less in the third quarter, and then 77 in the fourth quarter right now. That's based on my lower price deck. I took it from 67.50 US down to 62.50 in the next quarter, and then gradually up, because I do believe that once we get past this Trump tariff war stuff and they get some pretty good deals worked out with some of the bigger countries, maybe the political noise settles down a little bit, hopefully. And then I do have your realized natural gas price was $1.50 Canadian in the fourth quarter, and I got it ramping up a little bit every quarter going into the end. And I agree with you that I think once we get to 2026, you're looking at getting differentials back to a more normal situation. And if so, you could be looking at like $4 or $5 Canadian gas price. I really think we've got the situation that is even tighter than it was in the third quarter of 2022. When gas prices in the US ran up to $9, $9.30. we're at the same situation.
Yeah.
The gas and storage is 100 BCF below normal right now. We got all these AI data centers going. Are they talking about building AI data centers in Western Canada? I think I've heard that.
They are in Alberta, actually. Yeah, there's a push by the premier to support some of these new data center initiatives for sure.
Yeah, I made a presentation in May of last year, and the guy that presented like 2 times, she puts up a map of Virginia, and there was 25 data centers approved and in process of being built in Virginia. Those 25 data centers are going to use more electricity than New York City.
Wow.
I was just like, what? They're talking about bringing 3 Mile Island back online. I don't know. We're, and everybody we talk to, it's, always tells, well, isn't nuclear the final? Yeah. Here's the problem with nuclear. Nobody, no voter wants a nuclear power plant, no matter how safe you say it is, anywhere close to their home. And that's all going to be a continuing problem because they built the fear up about nuclear so much. Anyway, I think that does it, man. That was a great job, Sue. I'm very bullish on the company, which is why I do own the stock. And we will be following you closely. So that's
Great.
it. But anyway, thanks for
Thank
doing
you, Dan, for the opportunity here and facilitating all of this. We really appreciate it, and for your questions too.
Yeah, we will we recorded this, so we'll be sending this out to all of our members. So it goes out to about 400 or 500 global members that we have. And even though they're not really supposed to share it, they do share it. So when it gets live on YouTube, I think you'll see hundreds of views on this. So that'll be good. And then you will be getting a copy of the link, which you can send to all of your contacts if you wish.
Excellent.
And anyway, do you have? Are you getting what you think is fair analyst coverage?
The analyst coverage is really quite good. I would say yes. So
yeah, if when you get your first quarter results out in the early May, if you get some analyst reports, if you wouldn't mind shooting them over to me, I'd appreciate it compared
absolutely.
to my model. So anyway,
Yeah.
looks really good. Okay, Sabrina,
Okay.
why don't you end it there, and we'll send you guys a link here in a few minutes.
Great.
Great. Thank you so much, Dan. Yeah, thank you.